We need to be on high alert here into the bell. Hour left. Stocks have been making new lows. It looks like dip buyers are throwing in the towel here and bears are ready to feast. I think this could get really ugly into the weekend. A very distinct type of sell-off here, even compared to the recent weakness. The one thing that stands out, firstly, besides just the magnitude of the declines, especially in names like the e-commerce stocks that are down double digits again, is just the slow, steady grind. But that slow, steady grind could snap here and get worse. There's still a couple percent to limit down in stocks, and I'm watching Bitcoin too right now, trying to hold on for dear life. Seriously, I think this could get really ugly. Here's the reasoning why. Let's go into the movers. Let's start with what's happening in the dollar and bonds. This is a really important, crucial difference from recent selling. Generally, if those two top movers there are doing what they're doing today, this would be a big up day for stocks. Dollar down 1.5% and the 10-year yield lower too. Those have been very reliable. I can't think of the last time we've had both the dollar and yields down and we had stocks down like this. Generally, it's been the dollar correlation with stocks that's been very reliable, as the dollar signifies the inflation-fighting seriousness at the Federal Reserve. Look at that 10-day correlation between the NASDAQ futures and the DX futures over the last 6 months. It's almost always below zero. Zero is right there in the middle. Those peaks sometimes jump over it, but generally it's almost always negative, which means if the dollar's down, stocks are up. Why not today? Look at bonds in the yield too. The 10-year yield down, bonds having a big rally intraday. And if you look at the last 10 days, the chart for both the yield and the dollar looks like they're kind of struggling, maybe even rolling over. Yields are holding their own right now after the big jump earlier in the last 5 days and coming into this week after inflation. But the dollar's really giving a lot back here, going back to the CPI level. So why aren't stocks rallying? I've been warning that that dollar might lose its utility as an inverse signal to stocks because of all the other central banks that are now joining in the Fed's hawkishness. And that's what today looks like. This looks like a market that is figuring out that the path here for central banks, not just here in the US, but around the world, is going to be for sustainable tightening. That's different. When you see the dollar down and yields down, that's the best explanation. Yields being down because of the amount of risk off happening, where investors are just not sure what to do, so the reaction here when stocks drop 5% is to go and buy bonds. We've also seen that that still works in this market. Even though bonds have been having a terrible year, worse than many stocks in some cases, when stocks really are down big like today, 5% in the Russell, then you get a bid into the bond market as a safety trade. So the dollar here combined with bonds is a pretty strong tell that this is different. Okay, this isn't the bond market firming up because of where it thinks rates are going to go or something about inflation. It's the bond market catching a bid because it's getting a little worrisome that maybe the global central bank momentum here is going to stifle off growth in such a way that we do get that recession. So that's a different type of stock selling. And note that that is not turning into a rally. Because there's always that idea where, oh, if we do hit a recession, the economy totally hits the skids, the Fed has to back off. Market's telling you not right now. The dollar downside here can only be explained by the way the other central banks, namely the ECB, are trying to protect their own currencies by firming up their own path to hedge that dollar strength that we've gotten. Look for the Bank of Japan potentially. I mean, look, they're like the most dovish in the world, but you might see even some language start to shift. But really, this is about rates staying high for an elevated period and potentially inflation fighting by the Fed continuing even if the economy slows it down. That's not what you want. That's the worst case scenario for stocks if the economy slows down, but the Fed still has to keep hiking because inflation's too high. The worst part of the market here today is, again, SPHB, those high beta stocks getting slammed, but then there's also some really bad stuff happening in the consumer space, and that's really concerning, and that also fits the recessionary message or economic risk that's being priced into stocks right now. Consumer group is under some deep pressure. The reopened trades are doing terrible. The cruise lines are getting annihilated. The e-commerce trades are still going down. It doesn't really matter what you get in the consumer space. It's been disappointing. The trades have not been working all year. It's really bad stuff.